A new law in the United States may reshape the future of digital money. Strangely, it wasn't introduced as a banking bill or a cryptocurrency bill. Officially, it was a housing reform package, but buried deep inside hundreds of pages was a provision that drew the attention of the financial world. The United States officially prohibited the Federal Reserve from issuing a retail CBDC. Even more surprising, the law never received President Donald Trump's signature. So how did a bill that once failed eventually become law? What exactly is a CBDC? And is America protecting individual privacy or protecting its banking system? That's the story behind today's video. MegaPro gives you cashback rewards from leading exchanges, exclusive promotions, powerful trading tools, and a growing crypto community all in one place. Visit the website now to explore all the benefits and start maximizing every trade today. To understand why the United States decided to ban a retail CBDC, we need to go back to late June 2026. At the time, Congress had just passed the 21st Century Road to Housing Act, a housing reform bill that received overwhelming bipartisan support. With 85 votes in the Senate and more than 350 votes in the House of Representatives, almost everyone expected President Donald Trump to sign it into law. But that never happened. Just before the signing ceremony, Trump announced that he would not sign the bill. His decision had little to do with housing policy. Instead, it came after the SAVE Act, a proposal requiring proof of citizenship for voter registration, failed to pass the Senate. Refusing to sign the housing bill became a form of political pressure, yet his decision could not stop the legislation. Under the U.S. Constitution, if the president neither signs nor vetoes a bill within 10 days while Congress remains in session, the bill automatically becomes law. And that's exactly what happened. There was no presidential signature, no White House ceremony, yet hidden inside the new law was a provision that would reignite one of the biggest debates about the future of the US dollar. The most surprising part is that the CBDC ban did not originate in the housing bill. It began as a separate piece of legislation called the Anti-CBDC Surveillance State Act. Its goal was straightforward: prevent the Federal Reserve from issuing a retail central bank digital currency based on concerns that such a system could eventually become a tool for financial surveillance. The bill was introduced by Congressman Tom Emmer and narrowly passed the House of Representatives in 2025 by just 9 votes. But once it reached the Senate, it stalled and never received a final vote. Normally, that would have been the end of the story, but not this time. Instead of pushing the bill through on its own, its supporters took a different approach. They inserted its language into the 21st Century Road to Housing Act, a much larger bill that enjoyed overwhelming bipartisan support. In Congress, this tactic is known as a legislative rider, adding a provision to a broader piece of legislation to improve its chances of passing. As a result, a bill that failed on its own ultimately became law. But that leads to a much bigger question. What exactly is a CBDC, and why has it become so controversial in the United States? To understand why CBDCs are so controversial, we first need to understand how they differ from the money already sitting in your bank account. Today, when you deposit money into a bank, you are not holding it directly with the Federal Reserve. Instead, your funds are held by commercial banks such as JP Chase, Bank of America, or Wells Fargo. Those banks then use a large portion of customer deposits to make loans, invest, and support their business operations. A CBDC works differently. Instead of keeping money at a commercial bank, individuals could hold digital dollars issued directly by the Federal Reserve. For the first time, the central bank could provide digital money directly to the public. Supporters argue that this would make payments faster, cheaper, and more efficient. Governments could also deliver emergency payments or financial aid almost instantly. But those same advantages also raise concerns. If every transaction takes place on infrastructure operated by the central bank, the issuer could technically gain far greater visibility into how money moves throughout the economy than is possible with physical cash. More importantly, a CBDC could be designed as programmable money. For example, a $2,000 government benefit could be restricted to essential purchases such as food, or required to be spent before a certain deadline. Supporters see these features as powerful policy tools. Critics see them as giving governments too much control over how people use their own money. And that fundamental disagreement is what has made CBDCs one of the most divisive financial issues in Washington today. If the CBDC debate were only about privacy, the story would be much simpler. But there is another group with a great deal at stake: commercial banks Today, customer deposits are the foundation of the banking system. Banks use those deposits to finance mortgages, business loans, and countless other forms of credit that support the economy. But if people could hold digital dollars directly with the Federal Reserve, some of those deposits could leave commercial banks altogether. That would reduce the funding available for lending and could directly affect bank profitability. The risk becomes even greater during a financial crisis. With a retail CBDC, customers could move their money from commercial banks to the Federal Reserve in seconds using a smartphone. That could make bank runs faster and far more difficult to contain. For that reason, many banking organizations have publicly opposed the idea of a US CBDC. They argue that they are protecting the stability of the financial system. Critics, however, ask a different question. Is this really about protecting the economy or protecting the banking industry's business model? While the United States continues to debate that question, many other countries have already moved ahead with their own CBDC projects. While the United States has chosen not to pursue a retail CBDC, many of the world's largest economies are moving in the opposite direction. China is leading the way. Its digital yuan, or e-CNY, has already been tested across multiple cities, with millions of people using it for everyday payments, shopping, and government benefits. In Europe, the European Central Bank continues to develop the digital euro, aiming to modernize payments and reduce reliance on existing payment infrastructure. Countries including Russia, India, and Brazil are also testing or developing their own central bank digital currencies. Together, these efforts suggest that the global race towards CBDCs is already underway. That doesn't necessarily mean the United States is falling behind. The strength of the US dollar has never been based on technology alone. It also comes from the size of the American economy, the depth of its financial markets, and the global trust placed in the dollar. For now, no digital currency comes close to replacing those advantages. But as more countries experiment with new forms of money, the real question is no longer whether CBDCs will shape the future. Instead, it is this: as the world moves forward, will the United States continue to stay on the sidelines? By now, it's clear that the debate over CBDCs has never been just about technology. Supporters of the ban argue that stopping a retail CBDC is the best way to protect financial privacy and prevent governments from gaining excessive control over how people use their money. Critics see it differently. They argue that the issue isn't the technology itself, but the legal framework behind it. A CBDC could, in theory, be designed with strong privacy protections and strict limits on government access. Commercial banks also have their own concerns. If people can hold money directly at the central bank, the traditional banking model would inevitably change. That's why it's difficult to say that either side is completely right. What is certain is that the global race toward digital money is far from over. While many countries continue experimenting with CBDCs, the United States has chosen a different path. That decision may help protect financial freedom, or it may leave America with less influence over the next generation of the global monetary system. Only time will tell, but one thing is already clear: the future of money is no longer just about technology. It's about power, privacy, and trust.